Okay, we are back for the second episode of Chapter 7. And now we are going to talk about a couple of different ways that a company will raise money to finance their operations. So, in Chapter 7, we're going to talk first about borrowing money at a bank and signing a promissory note, which is an IOU to the bank. Then in the next video, we're going to talk about doing a similar type thing by issuing bonds. And then in Chapter 8, we're going to talk about issuing stock. So, as I talk about borrowing money, let me get me out of the way here. Now, first of all, let's talk about what's called capital markets, which is the market for capital or the market for money. So to do this, imagine that we are a Needy Corporation, and you can see here the balance sheet for Needy Corporation, and on the left side you see all the various assets that the company has, and on the right side, which is the right side of the accounting equation, that's what the right side of the balance sheet is, it tells where the money came from to get these assets. So remember that assets equal liabilities plus owner's equity. And if you recall from Chapter 1, the reason those two totals are equal is because it's the same money on both sides. On the left, it tells what assets we've purchased, and on the right, it tells where the money came from to get those assets. Same money. So, in Chapter 7, we're talking about borrowing the money. So we got to borrow it from somebody. Well, the market for capital, we call that the capital markets. Think of that as you got all these folks out here that have money. Now, it could be that we're talking about the rich tycoons, but we're not just talking about rich tycoons. We're talking about a whole bunch of just ordinary folks that have a little bit of money. And they put that little bit of money into the bank. And the bank, they're in the business of making loans with that money. So they pay these folks over here interest on their deposits. And then they turn around and they loan that money to other parties at a higher rate of interest, and that's how the bank makes their money. We call that the interest rate spread because they charge more on the loans than they're paying on their deposits. And then in the next video, we'll talk about this part at the bottom of this diagram. So today, think about what happens when Needy Corporation goes to the bank to get a loan. So the Needy Corporation is going to get asked for all their financial statements, and they want to make sure they are a good risk. But once they've decided to extend a loan, then the money goes to Needy Corporation, and Needy Corporation will sign a contract to the bank to pay that money back. This is called a promissory note, a promise to pay. And it's easiest just to think of it as an IOU. That's what a promissory note is. It's an IOU. Needy Corporation owes this money to the bank. So, I'm going to look at an example of a note and this agreement that we get into and pay an interest on it. So, here is a promissory note. It says on November the 15th of 20X7, Acme Corporation signed a 6-month, 9%, $12,000 promissory note to State Bank. So we're going to record this transaction for both Acme and also for the bank. Now, for our purposes in Chapter 7, we are looking at the liabilities. So we're going to talk about the note payable. That's what you'll be tested on. But at the bottom of this file, I will show you how the other side of the transaction is recorded. So we're just talking about this top portion. Remember that you may remember this formula. I equals P times R times T. That's the formula for interest. Interest is principal times rate times time. So we're going to be dealing with this calculation of interest on this promissory note. First of all, when we take out the note, we're going to debit cash and credit the note payable for the amount that we borrowed, which is $12,000. So that $12,000 gets credited to the note payable account. Over the life of this bond, or over the life of this note, we're going to owe interest. It's a 6-month note, and it bears interest at 9%. Now, interest rates are always stated on an annual basis. So the interest on this $12,000 note grows at 9%, but we've only got half a year to deal with. So in terms of the calculation of interest here, the PRT, the P would be the $12,000. The R would be the rate, which in this case would be 9%. Let me put that as a percentage. And then the T would be, since that 9% relates to an entire year, well, what portion of the year are we talking about? And we're talking about 6 out of 12 months because it's a 6-month note. So I've actually got that calculation down here. The total interest when 6 months is over is the $12,000 times the 9% times 6/12, that'd be $540. So let's keep that in mind, that this $540 of interest will have to be paid on top of paying the $12,000 note back. So we took this out on November the 15th, and then in item B says at December the 31st, what would be the appropriate adjusting entry? Now remember, adjusting entries are made at the end of the year to bring the numbers up to date, and so far we've had a month and a half involved here since we took out this loan. So the interest that has accrued to date, that has built up so far, would be, going back to this formula, PRT, principal of $12,000, 9% for a year, but now the only amount that has built up so far is for 1.5 months. So we'll multiply that by 1.5 out of the 12, and that's 135, and so the adjusting entry is to debit interest expense and credit interest payable for that 135. And again, that represents 1.5 months of interest that has occurred so far. So we're going to credit the interest payable for 135 and debit the interest expense for 135. And remember, adjusting entries are made at the end of the year. And so right after that, we make the financial statements, and then we make the closing entries. And as far as what we have recorded so far, it's only the interest expense that would be closed. And so that would go back to zero, like all expense accounts do. Remember, those are the stopwatch accounts that you set back to zero at the end of the year. So far we have recorded, we had a $12,000 credit to the note payable in entry A, and then we have recorded this interest payable in entry B of 135. So we come back to work in the next year, and 4.5 months later, the note becomes due. And we have to pay this note back, and remember, we have to pay the $12,000 back plus the $540 of interest. So I'm going to credit cash for that entire payment. The debits would be, first of all, $12,000 would be debited to the note payable because we're taking care of that liability. We're also going to debit the interest payable for the $135 that we had already recorded. at the end of the previous year, and remember that was for 1.5 months, we still have 4.5 months of interest to record, and that would be debited to interest expense. That would be interest that has been incurred in that second year. So to get to that 405, it would be the total 540 of interest minus the 135 that's already been accrued, or if you to calculate it, it's that 12,000 times the 9%, which is the full year, times 4.5 out of 12 months, and that's where the 405 comes from. Okay, so that's how a note is recorded and interest on that note. Now, if you want to look at the bottom part down here in the blue, this is just the flip side of the same transaction. This would be the journal and the ledger for the bank. From the bank's perspective, this loan represents a note receivable, and so they gave the loan to the company at the beginning. A month and a half later, they're going to record 135 of interest receivable and interest income or interest revenue. And then finally, at the end of the 6 months, they're going to collect the 12,540, and they would record the components of that. Again, just the flip side of what we dealt with from the payables side of the transaction. So in the Excel file that I've made available to you, I have a blank template for what we just recorded if you wanted to try that on your own. And I also have a side 2 template and solution, different numbers, very similar type of approach, and you may want to practice this. Also do some of the homework problems so that you're ready for the quiz, and then finally the exam covering notes and interest. So that's it for video 2, and then we have one more video in chapter 7 about bonds.